In this presentation, we're going to look at additional merchandise inventory items in a little more detail. Let's look at applying FOB terms. Recall from the first video, the Introduction to Merchandising Transactions, that we talked about the definition of FOB. Logan Appliances purchased $8,000 of merchandise, 210 net 30 FOB shipping point. The seller prepaid the shipping charges of $200. If Logan pays for this merchandise within the discount period, how much should Logan remit to the seller? First, let's look at where I have right here the discount. $8,000 times 2% of the 210 net 30 gives me a discount of $160. 8,000 minus 160 would give me $7,840. So this is just the cash that I would remit to the seller based on the purchase. Remember FOB shipping point? FOB shipping point means that transportation costs are paid by the buyer. In this case, we see that the seller prepaid the shipping charges. So what do we need to do? We need to remit the shipping charges back to the seller, because under FOB shipping point, the buyer is responsible. So the total that Logan should remit back to the seller is $8,040. Let's look at another example. G&G purchased $1,000 worth of merchandise on account. Terms 210 net 30 FOB shipping point. The freight cost of $50 were prepaid by the seller and added to the invoice. My first step is to simply record the purchase. And here I have my purchase of inventory and accounts payable for the full amount of the $1,000 of merchandise plus the $50 that were prepaid by the seller on freight. G&G paid for the merchandise purchased in the first section within the discount period. As you recall, our accounts payable was for the full $1,000 of merchandise and the $50 of shipping. They're paying within the discount period, so they are entitled to a 2% discount. What are we going to put that discount on? Well, we're not putting the discount onto the transportation cost. The discount does not apply to the transportation cost. So therefore, we're taking 2% of the $1,000 of merchandise we purchased. So here is our credit to merchandise inventory for the discount. Of course, our accounts payable, we had to debit for $1,050 to make it zero. So we remitted $1,030 cash to the seller. Let's take a look at another example. Glitter sold merchandise costing $100 to Gem on account for $250. Terms FOB destination. Freight cost paid is $25. FOB destination means that the transportation costs are paid by the seller. So Glitter is responsible for the transportation cost. In this case, we are the seller. Glitter sold merchandise. When we sell something, of course, now we're talking about sales. And so here we have our transaction to record the sale. We debit accounts receivable $250 and credit sales $250. Remember, under perpetual inventory system, when we sell something, we have the second piece of our inventory recording. So here we have cost of merchandise sold $100 and merchandise inventory $100. In this case, being FOB destination, the seller is responsible for the transportation cost, and therefore this is a delivery expense for Glitter. Delivery expense $25, cash $25. Again, this exercise was taken from the other perspective of selling merchandise and what happens to freight cost regarding a sale. Let's take a look at another example. On December 28th, 2000 X0, Kerr Manufacturing Company purchased goods costing $50,000. The terms were FOB destination. Some of the costs incurred in connection with the sale and delivery of the goods were as follows. Packaging for shipment, $1,000. Shipping, $1,500. Special handling charges, $2,000. These goods were received on December 31, 2000 X0. In Kerr's December 31, 2000 X0 balance sheet, what amount of cost for these goods should be included in inventory? Take a moment and pause the video and work this problem. Okay, well, let's talk about this problem. Well, what does FOB destination mean? It means that ownership passes to the buyer when merchandise is received by the seller. Transportation costs are paid by the seller, and then the risk of loss during transportation belongs to the seller. Well, what's included in transportation cost? These items are included in transportation cost. None of these items are going to affect the inventory of Kerr Manufacturing Company. The only thing that is going to be incurred for the cost of inventory is the cost, $50,000. Let's talk about inventory adjustments. Changes to inventory occur for various reasons. Expenses related to changes in inventory are cost of merchandise sold or cost of goods sold, and since merchandise inventory is credited, cost of goods sold must be debited. Physical inventory must agree with book inventory at the end of the period. GAAP requires a physical inventory. How do we account for this? Let's take a look at an example. G&G Company's perpetual inventory records show that there should be $89,500 of inventory on hand. A physical inventory count reveals that only $87,000 is actually on hand at the end of the year. The difference of what is on hand actually and what we have in our books is $2,500. Well, how do we know which way to put this? Well, our inventory account is too high. Let's take a look. We have our inventory, and it's a debit account, and we have it at $89,500. The physical count says that it should be $87,000. This is what we need to fix. So therefore, we are crediting inventory, and we will thus debit cost of merchandise sold or cost of goods sold, $2,500. Let's take a look at the closing process. We discussed the closing process at the end of our accounting cycle. Well, now we're going to add some accounts to the closing process. Additional accounts to be added include sales discounts, sales returns and allowances, and cost of merchandise sold or cost of goods sold. These are closed to the income summary account. Recall the balance of the income summary after the first two closing entries must equal net income or net loss for the period. Here's a review of the closing entries. There are 4 closing entries. The number 1, first one, close all income statement accounts with credit balances to the income summary. These traditionally are going to be revenue accounts. They're credit balances and they're on the income statement. Part 2, close all income statement accounts with debit balances to income summary. These are typically our expense accounts, along with some of our new additions such as sales discount, sales returns and allowances, and cost of merchandise sold, cost of goods sold. These accounts have normal debit balances, and we're going to close them to the income summary. 3. Verify that the balance in income summary equals the net income or loss for the period. Then you're going to close the income summary to retained earnings. And the very last piece, if dividend account exists, close the dividend account to retained earnings. In the document section, you will find Gems and Glitter Hobby Store adjusted trial balance. Please take a moment to prepare the closing entries for this adjusted trial balance. How did you do? You can check your answer with the solution provided.